Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. Welcome back. We're going to be talking about home equity loans. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. You can also go to my website, which is jareddillianmoney.com, or you can follow me on Twitter at DailyDirtNap, excuse me. They have these things called home equity loans. What a great financial innovation. Being sarcastic. So let's walk through how this works. You own your house. You have a $300,000 house, and you've owned it for 15 years, and you have 50% equity in the house. You own half. So the house is worth $300,000. You owe $150,000, and you have $150,000 in equity. Now the equity is, that's an asset that you have. So you don't really know exactly how much equity you have until you sell the house. If you have some estimate of what the house is worth, if you think it's worth $300,000, then you probably have $150,000 in equity. But if you go to sell it and it's $270,000, now you have $120,000 in equity. So it's just based on some estimate of whatever the value of the house is. And by the way, when you take out a home equity loan, they're going to send somebody to do an appraisal, and you're going to pay for that appraisal, and it's going to cost $500 or whatever. So your equity is an asset, and for a lot of people, it's their biggest asset. For a lot of people, they don't have savings, they don't have mutual funds, they don't. The house is the one thing that they have. That's the asset, and you can actually, tragically, borrow against the asset. So there is a thing, you can take out a home equity loan. Usually the term is up to 15 years. It's a loan, it's an installment loan, and the interest is tax deductible under certain circumstances. Now, here's the thing. Home equity loans have been around for a while, and the interest used to be tax deductible for any reason. So if you wanted to take out a $50,000 home equity loan and buy like a bunch of nudie magazines, then you could do that. Like that was within the scope of the law, and you could take a deduction on the interest that you paid. Okay. Now, after 2017, they changed the law. And if you take out a home equity loan, you have to spend it on renovations. So home equity loans are going to become much less popular. And these things were, in the mid-2000s, got to be insanely popular. Because what was happening was people owned their houses, and the price of their houses was going up and up and up, the value of the house. And they would get the house appraised. They had a $300,000 house. Now it's worth $600,000. So they would get it appraised. They get a home equity loan, and they'd extract all of that equity. And then they just spend it on cars and clothes and vacations and stuff like that. They spent, the funny thing is the economy was pretty hot back then. And one of the reasons it was hot is because people were extracting equity out of their houses, and they were just spending it on stuff. And, consumption was just like, retail was crazy and consumption was at super high levels. And it was because people were taking equity out of their house. Well, what happened was the value of the houses came back down, and then people had all these home equity loans, and they found that they were underwater on the houses. And, I think it was last night we talked about what it means if you're underwater on a house. Basically, you owe more than the house is worth. So then if you want to move, when you sell the house, you have to write a check to the bank. So this is the financial crisis in a nutshell, okay? Home values, doubled, and everybody extracted all the equity. They borrowed a bunch of money against their houses. Home values went back down, and everybody was underwater, That is what happened. So I think that was one of the motivations behind the change in the tax code, so that you can only take out money for renovations. Because otherwise, people were spending it on stupid. You could tap the equity in your house and buy a Corvette. Now, there's also something called a HELOC, HELOC, which stands for Home Equity Line of Credit, and it's similar to a home equity loan. So that it has more in common with a credit card. It's a revolving account. I don't know if you know what a line of credit is. Companies get lines of credit. A company can have $1 billion line of credit, and basically if they tap the line of credit, if they take $200 million out from the bank, it's like having a credit card. Like they just have to pay installments and pay it back. And that actually has a floating interest rate. Now, home equity loan interest rates are low. They're not as low as mortgages, but they're almost as low. Home equity lines of credit, they also have low interest rates. Technically, they're floating. It's not floating based on your credit. It's floating based on just interest rates. So interest rates can go up or down. So that's, they're short-term interest rates, basically. So let me get to the meat of this discussion here. Never do this. Ever. Don't do this. And now, if I was giving you this advice 20 years ago, what I would have said was only do this in case of emergency. Break glass in case of emergency. So if you got, arrested for something bad, it was going to cost a lot of money to get a lawyer, or if you had medical expenses or something bad. I mean, just basically like if you had a big unforeseen expense that was bad, then, back then I would say it would be acceptable to tap the equity in your house, because the alternative is you go to jail or you die, right? So I think that's an okay time to tap the equity in your house. Now, that's kind of moot because you can't take out a home equity loan for those reasons because it's just, for renovations. So I don't look, if you want to make reservations, if you want to make renovations on your house, just pay cash, like everybody else. Like it's, here's the thing. When you start tapping the equity in your house, you dramatically increase the risk that something could go wrong. For example, my house is paid for, okay? And let's say I wanted to build an addition on the house and I was going to take $150,000 of equity out of my house, okay? Now, before I did that, I had zero risk of losing the house. Now, I have non-zero risk of losing the house. I have maybe like 1% risk of losing the house. I mean, because once you borrow the $150,000, maybe something bad happens, maybe I have a medical condition, whatever, and then I can lose the house. So if you own your house free and clear, you don't want to give the bank a reason to take your house. I mean, you just introduced risk where there didn't have to be any risk. That's the issue. And there's also a phenomenon called reloading. And a lot of people did this in the past. They would take out a home equity loan to pay off like credit card debt, and then they would end up spending the home equity loan, and then they would have like home equity loan debt and credit card debt. That was called reloading. There was a lot of that in 2006. Anyway, if something happens, you could lose your house, and then you'll be totally screwed. The equity in your home is sacred. Do not touch it. Once you put equity into your house, once you pay down principal, don't touch it. The goal is to pay off the house. The goal is to not take out more debt on the house. That's like the opposite of the goal. And if you have this debt, you want to be in a big hurry to pay it off. I'm Jared Dillian. This is the Jared Dillian Show.
The Jared Dillian Show.